Hi everyone, Donnie Schultz, Embrace Home Loans, here with your market update. Friday, February 11th, a little bit after 4 p.m., and we are coming off another volatile week in interest rate markets. A lot of you have been seeing posts from realtors, loan officers saying, hey, 30-year fixed rate mortgages just creeped above 4%. They are definitely at the highest levels that we have seen in 2 years. There is a little bit of optimism going into the weekend that we could see a pullback here. We'll talk a little bit about that after we go through what happened this week. So since we started this, we've been talking about a shift in rate trends towards higher interest rates. It's caused by inflation, and it's caused by the shift in Federal Reserve policy to fight that inflation. So every week we have said, hey, rates are moving higher. This is why. This is why buyers want to be locking and you do not want to be floating. That narrative continued this week. Yesterday, inflation numbers came out hotter than expected. Markets said, hey, the Federal Reserve might need to be really aggressive with their rate increases. And that scared markets, right? We saw a jump in the 10-year Treasury, saw a jump in mortgage-backed securities. We saw rates go up about 0.25%. There was a lot of posts on Twitter this morning about a meeting that the Federal Reserve is having on Monday. It's called a closed-door meeting, and a lot of speculation that there might be an emergency rate hike in between the official meetings. I don't necessarily think that's going to happen, but that's the type of speculation that's in the market. It's feeding into these increases that we're seeing. So from Wednesday afternoon to about 1 o'clock today, we saw another 0.25% increase in rates. 30-year fixed rate was 3.75, went up to about 4% on most lenders' rate sheets. Now, at 2 o'clock, headlines started hitting in regards to Russia invading Ukraine, right? So headlines started hitting. They're saying, hey, there's a high probability that Russia is going to invade Ukraine as early as this weekend. And that type of global instability typically has a positive effect on treasuries and interest rates. So money started coming out of the market. If you look at the stock market today, it started dropping. Money started going into treasuries. 10-year Treasury dropped from 2.06 all the way down to 1.91. Mortgage-backed securities followed, although not to as big of an extent. So we did see from 2 o'clock until right now a 0.125% pullback in interest rates, right? So 30-year fixed rate should be right around 3.875 on the more aggressive lenders' rate sheets. That reversal, that trend, that pullback has the potential to carry into next week. So buyers who are going into contract, homeowners who we're on the fence about a cash out refinance, next week might be a really good time to be locking in interest rates because this longer term trend might pull back a little bit, at the very least consolidate, where buyers who have contracts coming in might not need to be as concerned about rates continuing to jump up higher and higher. That definitely could shift, right? If Russia does not invade Ukraine on Sunday, we can come in and rates could be back to 4%. So mindset right now, defensive. Anybody who is in contract, who has the ability to lock in their interest rate, should be locking their rate in. And they should be working with a lender who has some type of float down policy. So if the rates drop, they're able to capitalize and get that lower rate before closing. There's going to be volatility. Volatility goes in both directions. Rates are not going to move in a straight line. So we could see some big swings here, especially when there is conflicting reasons for rates to move in one direction or another. Russia, Ukraine, probably shorter term headlines. Inflation, shifting Fed policy, that's not going away. And that is going to, in my opinion, continue the trend for rates to move higher. How long does that last? How high do they go? I think, we still have a little bit of pain here. I don't think that we're going to see significant increases. I don't think we're looking at 5% interest rates. I think if the narrative goes back to Federal Reserve inflation, our ceiling is probably in the 4.25 to 4.5 range, and then things should settle down. Rates will eventually start moving back lower as the Federal Reserve shifts their policy, and that actually starts impacting the economy. Usually longer term rates are then going to begin moving lower. So A lot going on, scary. We just want to make sure that we're educating our buyers, that they understand why it's happening, and that they are protected. They're not getting bad advice. They're not being told, float your interest rate. You should not be floating right now. This trend has not been broken. Could that narrative change next week? We could be having a different conversation next Friday, but we have to see how it plays out, and we don't want to just assume that, all right, this is it. Now rates are going to start moving lower. If you have any questions, you can reach out to me anytime. Hope everybody has a great weekend. Talk to you soon.